Hi, everyone, and welcome to another interview in the Real Vision universe. I'm Andreas Larsen, and I'm the senior editor at Real Vision, and I am essentially bossing to debate the current equity market outlook with one of the absolute best equity experts out there, Eric Johnston, head of equity derivatives and cross-asset at Cantor Fitzgerald. A very warm welcome to the show, Eric.
Thank you very much. I'm excited to be here. Appreciate it.
How's life amidst all this market turmoil?
It's been, this has been one of the crazier markets, but, I feel like markets like this are actually can be a lot more fun than markets where sort of everyone's, straight up and it becomes a lot easier, maybe like it was in, back half of 20 and 21. So it's a lot more challenging and, can be a lot more invigorating.
I think that's a good way of describing it. We are recording Friday the 17th of June, towards the conclusion of this Federal Reserve week. This was the first 3/4 of a percentage point interest rate hike since 1994. As an equity investor, how would you assess the message that we received from the Federal Reserve and Jay Powell earlier this week?
So I think it's pretty interesting, and I think if you kind of take a step back as to what is going on. We all know that the Fed has been very behind this entire time. We don't need to walk through that, but I think it does sort of speak to where they are now, where they are getting the most aggressive at what is likely going to be the absolute worst time. And so if you look in the 48 hours around this Fed hike, you had the Philly Fed new order number come out, which outside of the pandemic lows was at a 9-year low. You had retail sales come in, retail sales missed, coming in at a negative number. And we know that consumer confidence is at a historic low. And while that's going on, we just had the largest Fed hike since 1994. And this speaks to the overall problem that the equity markets are facing, because these are very unfriendly dynamics to say the least. But it also speaks to, where the Fed is. And the Fed appears to just be chasing market Fed funds pricing, and has clearly, lost a lot of, credibility, which is creating a situation where the market has no confidence in them. 1 week before the Fed meeting, the Fed was resolute on going 50 basis points. And literally 1 week later, they have to float a story to the Wall Street Journal to say, hey, we're actually going to go 75. And so when they put out projections that are 6 months out, 1 year out, 2 years out, they really don't mean very much at all. And even this dot plot that they put out, if you look at the change just since March, right, their year-end Fed funds target doubled, and it's literally only been 3 months. So I think the lack of trust in the Fed right now is very high and well deserved. And I think that right now my view is that they are going to potentially, and I would say likely, overshoot, because one of the things that the Fed has shown is that they're doing very little. Their predictive power is not good, and so my concern is that you're not necessarily going to see it show up in the actual inflation data, even though it's highly likely that inflation is going to turn down very shortly. And that may cause them, or likely will cause them, to overshoot.
Let's stay on the topic of inflation for a short while here, because I noted that Jay Powell started referring very clearly to gasoline prices at the press conference this week. And essentially, it seemed as if the Federal Reserve started targeting the gasoline price, or at least headline inflation, as of the meeting this week. What do you make of the assessment on headline inflation versus core inflation when it comes to the Fed outlook?
Yes, as you said, you've made it very clear that ultimately headline inflation is what they are targeting, and use core inflation as a guide to what the overall inflation picture is looking like. The issue that we have is that much of the oil aspect of it is very supply driven. So historically, the Fed has been able to have more impact on oil prices because you typically are going to have supply stable, and it's really the demand that is the variable that is moving prices. And so the situation right where we are now is the supply picture, as we all know, is problematic, is challenging, and can't really be impacted by the Fed. Now, governments including ours, are clearly doing right now. They're throwing everything against the wall, and their incentives have never been higher to try to increase supply, even if it means doing things around Russia, Ukraine that may go against what they may have done towards the beginning of the war around sanctions, around insurance for ships, and around other things to potentially get around the sanctions that the governments have put in place. So this is really the challenge. I think that getting oil prices down is going to be very challenging / almost impossible without some sort of miraculous resolution in the Russia-Ukraine situation. And that's what makes it really tough. The other thing I would say is that to the point that we're throwing everything against the wall, if you look at the reserves that we are currently drawing down, that's ultimately going to create demand for oil down the road. And so, to me, use the SPR is becoming a headwind, and one of the things that will provide support for the oil market, because everyone is forward looking and they know there's going to be a large buyer in the market in the not too distant future.
If we look at the current sentiment, you mentioned initially that consumer confidence is basically at a multi-decade low. It seems as if investor confidence is also very, very low at the moment, but there is a huge discrepancy compared to the actual positioning of investors. You have a tremendous chart on this. Please take us through your thinking of why we see such a scenario right now with low sentiment, but actual positioning in the other direction.
Yes, this is a very important point. So over history, what we have seen is that investor confidence and consumer confidence are highly correlated to the individual investor's allocation to equities. So the world gets more challenging, investors lose confidence, they reduce their holdings, their allocation to equities, because they know this is the riskiest investment that they likely have in their portfolio, is also liquid, and so they reduce the allocation. And it has moved, it's been highly, highly correlated with this investor and consumer confidence over time. And what you're seeing right now, which is highly unusual, is that consumer and investor confidence is at the lows, yet equity allocations are at the highs, pretty close to the highs. So why is this happening? So one of the things that investors have been trained towards in the past, really since the financial crisis, has been that downturns are going to be short, and stock market downturns are going to be particularly short, because we will always get fiscal spending and monetary stimulus to essentially save the markets. And as a result, you may take pain for a little bit, but stocks always bounce. And you really need to go, prior since 2009, that's been the case. Now we're on to the 13th year of this phenomenon happening. And so I think the mentality of the individual investor has been twofold. Number one is I don't need to sell because I know stocks will bounce back. They always do. And then number two is they haven't necessarily adjusted to the higher rate picture that we're seeing globally. And for all of us that are in the investing world, we live the higher rates every single day. But for the average individual investor out there, they really haven't looked at fixed income. That is close to historic low allocation for some time because those yields across all instruments, not just treasuries, but across municipal bonds, preferreds, et cetera, have all been too low. And so that adjustment period saying, oh, there are alternatives to equities, I think is just going to take time. And so what does cause the individual investor to actually then reduce their allocation? And I think one of the big catalysts is going to be price, where right now they're already underwater. About $1.5 trillion has been added to equities in the past, call it year and a half. And the average cost is higher than where we are now. Not significantly so, but higher than where we are now. And so once that pain becomes large enough, I believe that they will end up to start reducing their position, because just like anyone in a losing position, at some point you can't take the pain anymore.
If we look at the current era with low interest rates, central banks always helping markets when needed, etc., we probably also look into a set of investors that are born and raised to a large extent in the era of the Federal Reserve put. And the interesting thing here is what happens if that put option is no longer in place. What do you make of the debate on the level of the current Fed put and whether it is at all in place anymore?
So, essentially, I would say it's not in place. And as you pointed out, it's a huge change from what we've seen. And not only is that not in play, but from a fiscal standpoint, we're going to have the midterm elections in just 5 to 6 months from now. In all likelihood, the Republicans will take at least one of the houses. And so the fiscal spending outlook for the next 2 years, really 2.5 years, because it's really from now, there's going to be no bailout for markets or for the economy based on those dynamics. So the fiscal put option is definitely not there. And from a monetary standpoint, I think that there is a level where the Fed stops hiking. But, it's hard to really call that a put option, because I think they're going to be far, far away from cutting rates and far away from, since they just started QT in the past 3 weeks, to think about them, stopping it and then reversing and going the other way is just, a pipe dream and just very, very far out. We would have to see much lower prices. I mean, prices that we can't imagine, I think, for that to happen. So it really, it's a huge change from what we've seen since the financial crisis and cannot be underestimated. There's no support. There's no down support for this market where the market can get bailed out. And that's a big difference. And that increases the risks in equities.
That's a really interesting point, Eric. We talked about positioning in equities still being quite optimistic, actually, when you look at the actual positioning versus this very downbeat sentiment. What would be the trigger? What are you looking for in terms of triggers for a change in the actual positioning in equities?
There's going to be a point where savings continues to be depleted, which is happening, as we speak. You can see some of the credit data, which was dropped to well below trend post the bottom of the pandemic, and has now gone all the way up to trend and actually potentially a little bit through trend. So, and then if you look at some of the other figures around deposits, etc., it does appear that most of the excess savings has now been depleted. And so if you get to a scenario where unemployment starts to tick up, which I think is going to happen, and you have a scenario where asset prices continue to fall, that there's going to be a situation where they're going to force themselves to begin to liquidate. And that's where it can feed on itself and become somewhat self-fulfilling.
If we look at the equity valuations entering into this kind of scenario, how would you describe equity valuations as of now? Are equities still expensive in a historic context, or are they starting to look more average? What would be your assessment of that?
So, I'm believe that they're on the expensive side. And so I think one of the important points is that, we look at, for valuation, we look at the equity risk premium. I've been looking at the equity risk premium as the valuation metric for, call it, 15 plus years. And essentially that is the inverse to PE. So it's the earnings yield minus the 10-year yield. And as we know, everything in this world is relative. So in the 70s and 80s, when the 10-year was trading in the teens, you had equity multiples that were went as low as the single digits. And if you're going to have a 10-year in the teens, you really have to be rewarded in a big way in order to own equities to try to outperform that return. And so in order to get that, you pay a lower multiple for equities. So and then to take the other extreme, we had the 10-year yield hit 50 basis points and the multiple went up to 23, 24 times, which makes sense because you're not getting any yield. And so your level around what you're willing to pay is going to be a lot higher for equities because you're not needing as high a return. So we think that this is the way to look at it. And if you look at the equity risk premium, it's actually this year it's declined. So right now on forward earnings, it's about 2.75%. The average over the last 5 or 6 years has been about 3.5%. And so there are a number of reasons why we think that equity risk premium should be higher, much higher than where it is right now. Number one, the risks are higher. We can see that in credit spreads. We can see it in commentary from corporate CEOs like Jamie Dimon saying we're preparing for a hurricane. You can look at all the recession models, which have significantly ticked up. We have inflation at 40-year highs. We have an experiment going on with unwinding a $9 trillion balance sheet. And so risks are clearly higher. So for that reason, we think it should be much higher than it is. And then the second thing is if you look at prior equity bear markets, the year 2000, 2001, 08, 2018, 2020, the equity risk premium rose in each of those situations by anywhere from 200 to 500 basis points. And so, and then one more stat around that is that 7 of the last 9 years, the equity risk premium has gone above 4%. Okay. So you have a lot of data in there that would suggest that the equity risk premium should be 4% or higher right now. And it's not. And to put that in perspective for the S&P, if you take the equity risk premium to 4% right now, that equates to about 3,250. If you take the equity risk premium to 5%, it equates to about 2,900. Okay. There's other metrics, and I would put two other metrics in front of you. One is to look at the capitalization of equities to GDP. And right now we're higher than where we were at the peak in the year 2000. And then you can look at dividend yield relative to the 10-year yield. That is at a 5 to 6 or more year low. So I don't see any metrics that would suggest that stocks are undervalued despite the sell-off that we've seen.
If you look at 12-month forward-looking multiples such as price earnings with expected earnings over the next 12 months, for example, then I actually think that you can make a case for equities looking cheap, at least on paper. But there's an important point to be made in terms of such forward-looking indicators, and that is that they are based on analyst expectations. And the big question mark now is whether these earnings expectations will hold true. And I have my doubts. Do you have doubts around the earnings expectations as well?
I do. One of the things, and I think we're going to see it show up in this quarter's earnings and guidance. If you look at the trends, one of the things that we've learned post-pandemic is that the activity that happened after the pandemic is causing a lot of skewing of data, right? And the pull forward effect and the underlying metrics within equities are a good example of that. So margins right now, if you look at operating margins over the last 7 or 8 years, they've trended right around 13% every year. And then in 2021, they spiked to 16%. Analysts are expecting that 16% to happen in perpetuity. If you look at return on equity, if you look at return on assets, those were all well above trend in 2021. And the assumption is that also will continue. And the market, as we know, has already sort of mispriced a lot of pandemic winners, where the market thought that a great percent of their prosperity during the pandemic would continue in perpetuity. We know that has now not happened. Now the market's saying that the margins, the returns are going to go on, for the foreseeable future. We would argue that's definitely not going to happen. And so we see margins coming down. The other thing I would say is that if the supply chain issues that the world has had was very helpful to margins. People looking to buy a car, cars were in short supply, and so you were willing, there was no discounting, you were willing to pay whatever it took to actually get that car because there was scarcity value. If you went to a department store, their inventories were very low. They didn't do any markdowns like they historically have. And this was going on throughout the economy. If you're ordering a dishwasher, a couch, etc., you couldn't get your hands on it. Hence, you're willing to pay the full price. So now that the supply chain is in the process of getting better, that's actually going to depress margins. And we're seeing it as we speak. Inventories are rising. Target and Walmart were clearly very good examples of this. Yeah. But it's going to go on throughout corporate America. So we do see earnings estimates coming down, and I do not think that's reflected in stock prices. And if you look at the years 2001 and 2008, the bulk of the sell-off started when earnings estimates turned lower.
This is a really important point because earnings, of course, matter for valuations. It's as simple as that. When you look a bit ahead on earnings, what are some of the forward-looking indicators that you tend to follow in terms of assessing the earnings outlook, and how do they look at the moment?
So one of the things we're going to be looking, inventories is a big one, and so inventories are rising. As we speak, and we're also looking at the new order numbers, which are falling pretty rapidly as we speak, and so that is a very difficult combination out there. One of the things that has not shown any cracks as of yet has been business to business spending. So that we're going to be looking at very closely. What we have seen is we've seen a sharp uptick in hiring freezes or hiring layoffs or slowing down of hiring announcements. We've heard that from a lot of different companies. And so when you think about when a company decides to take those actions, it's likely not in isolation. They are likely going to be making other decisions to cut other expenses and potentially cutting capital spending. And so that is something that could further reverberate through the economy and through corporate earnings. But that tends to be a longer lead time. The consumer can change their actions on a dime, whereas a corporate long-term planning can take a longer time to change. So you could have a rolling effect where initially it starts with issues that are directly related to the consumer, and then morphs over time to that business spending. So we'll be watching that pretty closely.
It sounds like you are painting a pretty bearish scenario for equities here, Eric. So I also wanted to hear your thoughts on how to assess when to pivot on such a view, because I mean, essentially, sounds like you expect equities to go down quite a bit over the next few quarters here. But what would make you turn around on such a view?
The first thing I would say that would be a major positive for this market would be a Russia-Ukraine solution in some form or fashion. And not sure what it would look like, but what I can say is that it does seem like the pressure to end this war from the US, Europe, and potentially China seems to be moving up. And the motivation to have it end, it seems to be increasing based on what we're seeing to markets, to nat gas prices in Europe, to oil prices globally, and to grain, etc. But you saw one move around fertilizer where the U.S. is going to allow fertilizer coming from Russia to be bought. And I think that was a indication that they're looking for any way to sort of get around their own sanctions that have been put in place. So I think a resolution there would clearly be a material positive. It would change the entire inflation outlook and the entire outlook for what the Fed is going to need to do. So that would be one. Two would be valuation. So, if one of the things with equity prices going lower is that it does help the inflation outlook. And so when you have prices in the S&P 500 move lower, and if they were to move to, somewhere in the 3,000 to 3,250 zone, you'd have a situation where valuations would be much more attractive and the inflation outlook would be much more attractive because that's clearly going to help the inflation outlook. And you would argue at those prices, again, the Fed will then need to do a lot less because the equity markets have then done the work for them. So that would solve a lot of issues, and I think would make the backdrop for pivoting much more attractive. So I think those are really the two things that I'm looking at. In the steady state of where we are now, it's very hard to paint a bullish scenario or something that would change my view. I think it's really those two things that would.
I personally think that a reversal of the price in oil and gasoline would be quite a positive trigger right now. That could be one way of gauging whether the Fed is at least nearing the end of the hiking cycle if we get a landslide in oil prices, but it doesn't really look like it right now. Eric, I also wanted to debate with you allocation trends into such a scenario, because we've been talking a lot about what to sell, basically, due to equities staring directly into a negative scenario. But are there anything that you would like to buy into this macro scenario?
I would first say that within equities, I think that China equities look attractive. So right now, China is one of the few places on earth that is stimulating their economy, both from a monetary and fiscal standpoint, is still in the reopening process, which could go on for some time with the zero COVID policy, but they are in the reopening process. Regulatory, they've clearly made a change there around their view of capital markets and corporates and what they want it to look like going forward. They've pivoted. which is important. And valuations there are very attractive. So, and then the final piece would be that they've now been, in many cases, de-risked, and a lot of investors have just said, don't want it anymore, and so have gotten out. And so I think they, China equities in particular, some of the technology names, I do think look very attractive. If we move beyond equities, I think, so number one, cash. Environments like this, cash is very valuable. The returns that you're going to be getting on cash are in the process of going, above zero. But more importantly, I think you're going to get an opportunity to make, 20, 30% on your cash, sometime within the next 6 to 9 months. So I think having that low return right now will pay handsomely in the future. As far as the bond market goes, I think that the view of the Fed hikes right now is likely at the peak. And so I think owning the 2-year as an example, right now I actually think looks quite attractive. If we look out even to the next Fed meeting, expectations are most likely for 75 basis points. Right now, my thinking is that it's probably going to be 50. There's a lot of time between now and there's a CPI report, et cetera. But I think speaking more just broadly over the course of the next 6 to 7 months, I think ultimately they're going to be hiking less than what the market is currently pricing in, currently around a 3.5% end of year funds rate. I think that'll prove too high. And so, owning the 2-year looks attractive. And then in the commodity space, I can't say that anything there is really sticking out to me as something that I would like to own. I think the oil trade, I think the risk reward right now at these prices is no longer that favorable. I think in all likelihood we're going to see continued strength in oil, but I do think that you have that the idea out there that if there is a supply fix, that you could have a gap lower. And so when I look at the upside downside, I would say it favors the upside, but the reward I don't think is good enough to equal the risks.
If we take a step back and take a look at the chart that we had on the screens initially in this show, showing the discrepancy between the sentiment among investors and the actual allocation to equities among investors, the respondents in the survey that you use in this chart are all based in big institutions. Oftentimes they cannot just hiding cash to any large extent. So the money currently placed in equities among these institutions will be headed where, Eric?
If they move out of equities, where will it go?
Exactly.
Yes. So I think, if you look at the same chart, which I don't have with me, but the same chart from a fixed income perspective, it looks the exact opposite of the equity chart. And so I do believe there is going to be a rotation into fixed income assets. And if you look at some of the spreads right now, whether it be credit spreads or MBS spreads, municipal bond spreads, they've all had a situation where the risk-free rate has moved up. And in addition, you've seen spread widening, where you can find some fixed income trades that look like a place where one's allocation should be higher than what it is now, based on the moves that we've seen in these yields and in these spreads.
If you look at the Federal Reserve over the coming, say, 2-3 quarters, One of the things that we've only touched briefly upon is the balance sheet tightening plans. As you mentioned earlier, they started tightening the balance sheet size this month. And essentially, you are now telling us to buy bonds into a scenario where the Fed will offload bonds to the private market. Could you take us through your thinking about the quantitative tightening process and how that spills over to your asset allocation thoughts over the next quarters?
Sure. So the first thing I would say with the balance sheet is that we've seen that the equity risk premium is highly, highly correlated with the slope of the balance sheet. So if you go back to 2010 and you look at every time the balance sheet has gone sideways or down, and it only went down for about a year and a half in 2018, but sideways or down, the equity risk premium has risen sharply, meaning stocks have gotten cheaper, valuations have come down. And then when you've seen the balance sheet ramp up, valuations have surged. The equity risk premium has gone down. And it's happened like clockwork. And so the balance sheet currently is just under 9 trillion. At their current forecast, it'll be reduced by about 1.1 trillion per year. And to get down to a target number of, probably somewhere around 5 to 6 trillion. So presumably this going on in theory for a few years. So number one, that should hit equity valuations, as that has been the trend for the past 12 years. One of the things that's gone on when you talk about the supply-demand dynamics within the bond market is that there's been a surge of revenues to the federal government. And so, as a result, the supply that we've seen coming to the market, post-pandemic has been in decline. So as a result, that's coming down along with, the Fed purchases, moving lower. So that will offset some of the reduction of QE. So I would say overall that even though they're going to be letting this balance sheet run off and importantly not selling, and I don't expect them to sell, that shouldn't increase the supply demand dynamics to be off by that much. So what's going to fill in the balance and actually cause more demand than supply to move yields lower, like we think that they will? So it's going to partly come from that allocation change that I think is coming out of equity to bonds. Number two is I think it will come from from foreign investors who are looking for yield and are looking to park their money in the dollars. So I think that'll provide some offset, and especially as volatility comes down, that will entice bond volatility comes down. That'll entice more investors in because the returns will look more attractive.
Yeah, if we look at it right now, we have the liquidity cycle pointing down. We have the growth cycle pointing clearly down. The question mark is in front of whether the inflation cycle is also pointing down. But if we have these three cycles pointing in the same direction, then it's usually a good idea to buy bonds. I would tend to agree with that. When we're talking about liquidity, because that's obviously also linked to Federal Reserve policies on the balance sheet, do you think there's a risk that liquidity will dry up across markets over the coming quarters as a consequence of this balance sheet tightening process? So how do you view liquidity in a broader scale?
Yeah, I think that's a great question, because I do think that what we've seen is that as volatility picks up, as the direction of stock prices and bond prices have gone down, that liquidity has gone in the same direction. And so, and this is not that unusual in history, and I would expect that correlation will remain. which means that if stock prices continue to go lower, I would expect liquidity to continue to dry up. One of the things that, if you talk about liquidity in this overall system, you have M2 money supply, which declined for the first time this past month since 2010, and that was before the start of QT. So, from an overall money supply basis, certainly the year-over-year growth numbers are going in one direction, and the absolute number could also be declining, which is fairly unusual, and will be a headwind for overall liquidity, and then also in equity markets. One of the other dynamics that you've had is that there's been a trend for the last 20 plus years of the growth of index funds, and so that has always been a concern that would take liquidity out of the equity markets, and I think that's it's happening. It's a slow, incremental process, but if you look at what it's done to liquidity today versus 10 years ago, it's clearly had a negative impact. And so every day that goes by, and index funds have a larger percent of mutual fund assets, that also is contributing to lower liquidity in the markets. And so right now the liquidity in the bond market is epically low levels, which is concerning. And then we also saw with the credit markets, any sort of turmoil like we've seen, and the high yield market almost shuts down, and the high grade market can shut down for certain periods of time. So as things get worse, that also becomes self-fulfilling with those type of liquidity issues getting worse.
I attended a conference earlier this week with participants also from central banks in Europe and from the financial authorities in Europe. And it seems to me as if this is a question that they don't really care about, to be honest, because the only enemy right now is inflation. So therefore, this is not on top of the list, at least. So I perfectly agree with you. I lean the same way, that I think the liquidity issue is very present, and something that we should also be very aware of over the next couple of quarters here. We are headed towards the conclusion here, Eric, and I wanted to provide you the chance to give sort of a brief summary of the quarters ahead, seen from your perspective. Equities look expensive, but there is a potential in bonds. How do you sort of view the positioning that you would take on your books into such a scenario here over the next quarters?
So I think from an equity perspective, as you know, the direction I believe is certainly down. I am very keenly aware that we've seen in all bear markets that you get very sharp rallies within those bear markets. A lot of times those rallies can come from headlines where governments are trying to do things artificially to help situations which long term have no effect or potentially a negative effect, but in the short term can create short covering rallies. And we do have some institutional investors, from a shorter term perspective, that are pretty negative, and so could cause some sort of a squeeze. So the bottom line is that looking out the next 6 months, I think equities are going to touch the low 3,000s at least, but it's not going to be a straight line. And so when you are in oversold positions, situations, I would be reducing short exposure, because you will get bounces and it's unlikely to be a straight line. As far as from a bond perspective, I think the narrative is going to change very quickly around inflation, and the narrative around the Fed. I think there is going to be a view that the Fed is going to be significantly at risk of overshooting. I think expectations for Fed hikes are going to come down. And I think the inflation data, whether it actually shows up in CPI or not in the next month or two, I don't know. But I think a lot of the underlying data is going to show that inflation is now headed lower, and potentially at a somewhat rapid fashion over the next 6 months. And so I think that's what's going to create the bid to the bond market. And so I think, and we're trading, Fed fund futures. I think that is a very good trade because I do think that the view of the hikes is at its peak.
I tweeted earlier this week that in a year from now, we could actually be back debating negative interest rates in Europe and maybe even in the US as a consequence of the very, very firm cyclical slowdown that we are staring directly into. I always allow my guests at the end of the show to also talk a bit about the horizon that's non-tradable, you could say, like 5-10 years out. You're negative on equities over the next couple of quarters, but if I give you the chance to come up with a forecast for the next 10 years, will they rebound?
So I think that returns over the next decade are going to be fairly weak. And the reason why I say that is because I think from a big picture perspective, over the last 13 years, we've had a big picture bailout from a fiscal monetary perspective. And that needs to be unwound. And unwinding that takes a very long time for things to normalize and to reduce the size of the balance sheet, get the fiscal side in order, people to learn lessons from the overstimulus that was provided earlier in 2020 and 21. And so I do think we're going to have below average returns for equities. I think from a bond perspective, contrary to my 2-quarter view, I would say looking out the next 5 or 10 years, I would expect bond yields to more normalize to the upside. And so we've had this 20-year bull market in the bond market. It has started to reverse, and I do think that the trend over the next 5 to 10 years for yields will be higher. So higher bond yields, equity prices that go that underperform sort of the averages. And then I think from a commodity space, I think it's a good outlook. Looking at copper is one that I'd be very focused on. That I think over the next 5 to 10 years, decarbonization and onshoring and other trends that are going on, that there should be a tailwind for commodities like copper.
Eric, it's been a great pleasure to debate the equity outlook with you, both on a tactical horizon and on a more structural horizon. It seems as if the two of us agree that there is a high risk of a further sell-off over the next couple of quarters here. So thank you very much for spending your time with me this afternoon.
Absolutely. It's been a pleasure. Really appreciate the conversation. I enjoyed it.
Thanks, Eric. My name is Andreas Larsen, Senior Editor at Real Vision. We will be back with more soon. Thank you so much for watching.
Hi there, visionaries. If you want to get more of these kind of insights, join our community over at realvision.com. There you'll get unbiased insights and exclusive access to the very best, brightest and biggest names in finance. Be a part of our community of lifelong learners. See you there.